All right, everybody, we're going to move on now to part two, or part two of session one here for y'all. Let's talk about the different types of notes in your note niche, kind of the basics out there for you guys that are joining us for the first time and kind of dabbling in the note space. You know, what is notes? We get a lot of landlords, we get a lot of fix and flippers, we get a lot of people that are tired of totes and trash outs, people that are in expensive markets that can't find anything locally that makes sense. They're looking, you know, got some money, 100, 200 grand to do something with, but maybe that's way under what your market is at. I understand. I live in Austin, Texas, very expensive market, very popular market. We don't see a lot of distressed debt here. I mean, we have a little bit, but for the most part, it's overpriced because Texas is a fast foreclosure state. But what you're going to see, the majority of the stuff that you're going to see is going to fall into these categories out there. You're going to see residential first liens, performing notes that you can pick up from banks, from hedge funds, from real estate mortgage companies that have had some stuff on their line, performing stuff. They'll usually sell this either at par or a little bit of a discount, especially if you're buying it from other note investors who maybe will get a little bit of a discount. Obviously, my bread and butter is the residential non-performing notes. By non-performing, I mean non-performing. That means somebody hasn't paid on their mortgage. And I'm usually, you'll see some stuff that's under 90 days. It's going to be more closely to what's the unpaid balances that they're going to want you to buy that. But I don't look at non-performing unless it's usually at least 6 months in default. That's when I start seeing the bigger discounts out there on the residential side. 6 months in default. Anything less than that, you're probably looking at, if somebody's only 30 days late, it's only about a 5 to 10% discount. If they're 60 days late, you know, 15 to 20. If they're 90 days late, maybe a 20 to 30% discount. After 90 days, it kind of changes things and how the bank reports it. You start seeing bigger discounts after 90 days, but usually the best discount stuff comes after 6 months of default. You will see some junior liens performing and non-performing. We don't see much of it. I had people reach out to me looking for junior liens. Somebody yesterday was like, I want to buy first and junior liens. Okay, well, I don't see a lot of junior liens. A lot of the guys and gals that have been investing in seconds have transitioned out of junior liens and more into the traditional real estate side of things. Right, but occasionally you see some stuff. I have bought some junior liens before, but they're usually the liens behind my first lien. All right. Only time you want to get in a junior lien position is buying a non-performing junior lien that falls behind a performing first lien, because you don't want to get wiped out to the first lien foreclosing. Obviously, still need to check taxes and go from there. We'll see a lot of commercial paper already starting to bubble up on the market here. Performing commercial loans, you'll have non-performing, quite a bit of that here as things settle out, and the market's kind of trying to figure out where things are. And I think we'll see a much clearer picture of where we're going on both the residential markets and the commercial markets here in the next 90 days. You'll see owner finance notes. I know I have some people on here looking for owner finance notes, performing and non-performing. Nothing wrong with that. Owner finance can be great deals as well. You want to make sure that it's underwritten properly. It's Dodd-Frank compliant mortgages. Preferably that there's an NMLO, a National Mortgage Loan Officer, loan originator who's reviewed the files and made it a clean file. You want something written on a napkin. The thing I'm not the biggest fan of owner finance notes is you got to do a lot to really find it. If you're going to buy a note from an owner finance seller, you're probably going to see maybe 1-2 deals to the max. The reason I like going toward the institution side, banks and funds, is that they often have a variety in a large list that I can cherry pick from. And don't let anybody tell you that you can't buy direct from banks. That is a bunch of BS. Now, you're not going to buy from Bank of America, Chase, Citi, Wells Fargo, those kind of things. Those, top 5 or 10. But there are plenty of other regional banks, and we'll get to some of that stuff later on. You'll see some contract for deeds, CFDs. What is a contract for deed? Well, contract for deed is still a note, but it's more of the deed stays in the name of the property owner who is selling the asset via like owner financing. Usually you're going to see these predominantly on lower valued assets, usually below $100,000 in fair market value of the property. Why that amount? Especially below 75. Is because the banks, it's hard to get a loan for anything less than 100,000. So the sellers realize that these buyers aren't going to really qualify with the bank because the banks aren't going to lend to them, and they often will have maybe a little trouble credit. So doesn't mean bad things. I've bought plenty of contract for deeds in a lot of states. Instead of a foreclosure, it's an eviction, which is beneficial and faster. In other states, they treat it as a traditional note, and then you got to go through the foreclosure process. So each state's a little bit different that we see out there. So we'll get more of that. Lease options is very similar to CFDs. We'll sometimes see portfolios of lease options that are rolling around. I haven't seen one in a month or two, but occasionally you see somebody who's done a good job of putting lease options and trying to sell their portfolio. Wesley says the discount values you cited are the standards. No, I'm not. It's not standard, Wesley. It's going to vary on a variety of things. We'll get to that later on. But that's kind of the discount ratio. This is why I'm not going to waste my time going after anything that's less than 6 months in default. Because usually if somebody's a month or two behind, maybe it's just a month, maybe it's 5% discount. You know, the bank's aren't going to take that big a discount off of the balance. So I'll just wait and come back on a later rate. Plus also too, if a borrower's less than 90 days, they may have the ability to come back and repay. So that's why I say after the 90-day period that's where you start seeing bigger discounts drop in, but it's going to vary on state, foreclosure time frame, demand, values, you know, if it's a hot market or slow market, rural market, you know, or in town. So it's very a little bit there for you. So here's a couple things on where should you focus, because that's the biggest thing. Notes can be exciting, but what's in it for you? Where should you focus? Okay. And we get a lot of people come in. There's no wrong answer to this. Okay. There's no wrong answer. It's all about what you are focused on. Okay. And here's a different thing. I don't want you, if you're on here and you're just thinking you're going to get a wholesaling notes where you're just going to be flipping paper, that's okay, but that's not a long-term business model. That's a broke model. You have to change your mindset a little bit and realize you need to be buying for your own portfolio first and foremost. Okay. So just looking to sell because I don't have any money, stop that. Okay. Realize if you learn to market, like I'm going to talk about here, if you're going to wholesale, you got to be a good marketer. So you might as well just market for buying these deals yourselves and staying involved. Cash flow is one of the biggest things that we look for. And that's what in the note space is all about, cash flow. You need stuff reperforming or buying performing so it performs on a monthly basis. You also have the other people that are like, well, I get into the notes to find property. That's great if we see deals in your state. But who wins ultimately in the finance game, in the property game? Not the lender, not the borrower. I mean, sorry, not the property owner, not the fix and flipper, not the landlord. The lender always wins. Okay. One of the biggest mistakes I made early on in my note business career was I tried to foreclose on everything the first 2 years that I was in the business. I want to foreclose. No, I don't want a loan mod. Oh, why would I want to do that? Stupid. I should have been loan modding a lot more times. It's a lot less work versus having to take it through foreclosure, having to look to then fix it up, then to flip it. If I just get things reperforming, it's cash flow, and then in 6 to 12 months, if they've been performing for a while, I could turn around and look to sell it at a sizable price increase. That's not saying I don't take property back. We've taken plenty of property back. Got some property back right now that we're looking to move. The thing that you want to keep in mind though is building systems for your business model. Don't be chasing these one-off, these crazy weird deals. Bread and butter, stuff that you can do and you get it down specifically. Focusing on a couple states to begin with, all right? Deals, places where there are deals. Getting a system of doing that and understanding that. And, you know, you got to look at your stuff. What's the best ROI for your time? Return on investment, but also ROT, return on time. A lot of people, when they look at rentals, especially when we start breaking down numbers, for us to take a property, a note, and either modify it, nope, we're going to go to foreclosure. Okay, then we'll go to foreclosure. We want to take the property back and then turn it a rental. That's usually the least productive return on investment for us to turn it a rental. Least productive. When you start looking at the numbers to getting stuff in, get it modified, great, boom, get rock and rolling, that becomes the highest ROI for our time. Okay, inventory. This is very important thing. I'll give you an example. You got to be looking at a couple states. If you're in California, West Coast, looking for notes in your backyard, I'm sorry. It's probably not going to be a good price point, right? Where do I see a lot of inventory? Ohio, Michigan, Indiana, Illinois, Carolina. See some stuff in Florida, Virginia, Missouri, Kansas. I'm probably missing a few states in there, occasionally in Arkansas. You got to look where the deals are. And part of the reason why, instead of us chasing states, a lot of times we'll go and see what the lenders have. And what the lenders send us, then we'll spend time diving into what they have and going from there. But I would say pick a couple states, 2 or 3 states, email me what the states are that you're looking for. And I'll tell you, this is a good state. No, it's a bad state. That's not saying I'll give you an example. Austin or Texas is not my top 5 states. I live here. I love the state. Love being a Texan, especially Austin. But I don't see a lot of stuff here. So if I was just relying on stuff in Texas, I would go broke a long time ago. And my markets have changed as the markets have changed. All right. So I want you to do me a favor. Just take a relaxing chill for a second and realize, hey, there's vendors everywhere. Realtors, foreclosure attorneys, door knockers, rehab crews, if you need to get into that. But all your vendors are not just in your backyard. They're everywhere. You can have people go drive by property. Heck, worst case, jump on a Southwest Airlines flight and fly out. That's why I like being central part of the United States. I'm about 2.5 hours from 90% of the country. Okay. And then you also have to look at pricing models besides just inventory. Like I said before, stuff is very expensive in your very fast foreclosure areas. Like Texas, fast foreclosure state means the distressed debt is more expensive because it can be done faster. Same thing with Georgia. You look at California as a hot market. Stuff in Miami Beach is expensive. All right, got to look at that stuff. You also have to look at the foreclosure timeframes. How much time is it going to take you to foreclose, and how much time do you really have in your schedule? This is kind of a double-headed monster you have to look at. How much time do you have to put to something, and then is your business not going to work within that time constraints? If you've got 10 hours a week, great. You can often put some things together. Start off with some performing notes. If you're worried about cash flow and you got to make some cash, okay. Let's go find you some performing notes that you can bring in, market, get some cheap money to fund those deals, IRA money, self-directed IRA, friends, families, that you can arbitrage and start making some good returns to cover your bills, and then you're a lot happier off. This is not a get-rich-quick scheme by any means of the imagination. This is a build a wealth model. So do yourself the big favor and sit down, be honest. Hey, what do you want to accomplish? If you're trying to make $100,000 in the next 90 days, I'm sorry, not going to work. You might need to go rob a bank. But you could put together a plan where you're bringing in $100,000. You can focus on closing on 20, 30 deals in the next 12 months. And we've put together a video. It's one of the things that we do on a regular basis. The first usual session of our virtual note buying workshop is our how to make $250K in the next 12 months. All right. So there's a link for it. I highly encourage it. It's a business model plan, putting together, getting performing notes and holding on to them and working to build those numbers. But identifying opportunities, identifying what you want to focus on can be very directly relevant to what you need to bring in. So be honest with yourself. Hey, I want to make 10 grand a month. Great. That means you need to probably take down 20 deals. All right. Cover that all in that video. There's a great way there for it. Okay. You also to look at the states and look at the foreclosure timeframes, judicial versus non-judicial foreclosures. You can always download a Fannie Mae foreclosure timeframe. Foreclosure is a little difficult right now, obviously. Many states, counties put moratoriums on the foreclosures because of what's going on in the market. That's okay. So look at the states out there that have the longer foreclosure timeframes, specifically like New York, New Jersey. Don't buy there. It's just going to take a long time to foreclose, and the longer it takes to foreclosure, the more cost will be. I'd also avoid Cook County in Chicago. Not a great place to foreclose in. Other counties in Illinois is not bad. It's just that Cook is very corrupt. So don't waste your time in Chicago unless you live locally. That's really what you have to have. You got to have a local presence there. How do I know? I've lost money in Chicago. All right. Not a great market. Should never dive into it. Hey, you live and learn and move on. Please learn from our mistakes. That's what I can tell you. Okay. Foreclosure costs. If you need to foreclose, it's going to be anywhere from $1,000 to $10,000, depending on the time frame. 10,000 is going to be your extreme, primarily around New York, New Jersey. $1,000 is going to be your fastest states, like here in Texas. Georgia may be about 1,000 to 1,500. You'll see some, flow in between there. What I do is I'll budget anywhere from 2,500 to $5,000 in foreclosure costs when I'm calculating in my costs on a deal. I'll figure that in that aspect as well. Okay, time frames, like we talked about, that's important. If you can't get a borrower to modify in the first 90 days, you probably need to go and start enforcing the legal, start the legal process to start foreclosing. You're going to have some costs along the way in business. You can't do this business without cash. And by cash, I don't mean you have to have a lot of it. You can often, if you're buying a deal that makes sense and at a big enough discount, you can often squeeze in some of your expenses to be covered. But you're going to have some marketing costs, okay? You're going to have some due diligence costs, pulling O&E reports, getting BPOs done. You know, those are two of the biggest things. Sending out vendors to door knock or realtors to do drive-by BPOs, you know, things like that. There are going to be some costs. And each state's to be a little bit different on that, okay? As Wesley asked, licensing requirements, do I need a license? No, you don't need a license to start trading notes, okay? The states that require, the strictest is, your first one is Georgia. They want you to be a mortgage broker there. That's going to require you to get a bond. Some people get it, other people avoid that state. Now, Georgia has one exception to having the need to be a mortgage broker to buy notes, is that if you're buying with your self-directed IRA, that's an exemption. Don't understand why it is, but if you're buying at least one note or more, they want you to be a licensed mortgage broker. Now, how do you get around that? Well, find somebody in that, who's another note investor who's got that license there, and just partner with them. Find those people in the WCN crew. Okay. Another thing that is another state that's a little bit strict, you don't want to buy in Kentucky. What's wrong with the bluegrass state? Well, the Kentucky's are going to require you to have $1 million bond. Yeah, not cheap. So avoid that state. Illinois, once you have a debt collector's license, not bad to do. Like I said, Washington State wants you to be a mortgage broker. North Carolina is now passing a state that wants you to be a mortgage broker. Massachusetts is also strict that way. But everybody got to realize, if you got a licensed servicer or you got a servicing license, you're covered in most states except for a few exceptions. You can always follow that. Shantae Duffy at Madison Management has done a really good job of posting. I think she's got an article she's working on right now of the states that require a license that don't require a license. Okay. Where am I? Okay. Look, if you've, like, I buy in about 30 states. Okay. Ohio, Michigan, Indiana, Illinois. I do have a debt collector's license in Illinois. It's like $750 every 2 years. There's plenty of states out there that have inventory that, as long as you're using a servicer to collect, to do the call outs, you're going to be fine. Okay. That's where you're going to be okay. Okay. What's available in today's market? People ask. Well, there's a variety of things. We do see contract for deeds being available. We are seeing mezzanine loans from hard money lenders that are showing up in the market. Some of those are taking discounts. Some of those are wanting to be sold off at par. With a hard money loan or mezzanine finance, those loans are usually at 65, 70% of as is or ARV, after repair value. Looking at those, some of those may be finished projects, some of them may be vacant, unfinished or finished. So you got to take a look at it, understand the due diligence. And, we've bought some mezzanine loans that have been great deals. We bought some ones that have been duds. It all comes down to making sure. I would not waste your time with unfinished projects. You're going to be buying something, make sure it's finished. Make sure it's not a slab or just a frame. We've done that before. Bought a portfolio, turned out inside of one house was just unfinished. It was just the 2x4s. All right. No sheetrock, no power, no electric, nothing like that. So just make sure there's plenty of opportunities, and don't get the idea that don't let the want to do a deal put you into a dud. Okay. Don't get so, I've seen this happen before. Investors are like, I want to do a deal. I want to do a deal. I'm just going to do a crappy deal. No, don't do a crappy deal. Don't waste your money on a crappy deal. That doesn't build confidence. If you need to run a deal by me, hey, does this make sense? Hey, do so. Give me a phone call. Drop me an email. I'm glad to help you look at your first couple deals with you. All right. I don't care if it's a contract for deed or first or an owner finance notes. I will give you my unbiased opinion, my unbiased counsel, and say, well, look for this, or don't look for this, or look for this. Have you asked this? And go that route. I'm here to help you succeed. I don't want to see you guys fail. Okay. Biggest thing, number 6 here, is you want to have a banker's mindset versus a fix and flip mindset. If you're coming into this, and I've talked about this beforehand, that I want to take it down for more property. If you're buying property or buying notes in a state that has longer than a 6-month foreclosure time frame, it doesn't make sense for you to go, hey, I'm going to take it back to, I'm going to foreclose and take it back and turn around and rent it out. That's great, but that's not going to get you long term. get in the habit of looking at where you can buy assets. And I prefer occupied assets. There's more exit strategy to those, more opportunities to get reperforming, and start looking at the numbers. What's the rent rate compared to the mortgage rent rate? Higher, then it's easier to get you to modify. What's it look like? What's the ROI going to be if I get them to reperform off what I'm paying for it, plus taxes owed? Is that a good return? Is it a double-digit return? Okay, it's a double-digit return. Can I go get single-digit money to find that to arbitrage my own funds? Or if I have to use my own funds, then I can refinance my own funds out by bringing somebody in who wants a lower interest rate. Okay, a banker's mindset is you want cash flow. You want money coming in on a regular basis. That's how you get ahead. That's why the banks are in the lending business, not the real estate business. Okay. Any questions about part one here, everybody? Or part two. 3 types of notes in your niche. Okay. And here's the thing. If you got a deal sent to you, then get all the information. All right. Don't just reach out to me and say, hey, I got these info points. Well, what's the deal? Tell me the story. Every deal has a story. Okay. If you don't, here's the big thing too. If you are out marketing and you're getting deals sent to you, find out what they want for it. Ask. Don't just sit there and start doing due diligence, because if they want full par, and par is basically what's owed, that's not a deal. And then there's a ton of equity. It's still not a deal. Okay. Ask, what are you looking for on this? What kind of color or discount are you looking for in selling this notes? What are you looking to get for this? This one comes and tells you I want par. Oh, sorry, this doesn't make any sense. Even if there is a ton of equity on a non-performing note, getting par isn't going to make sense. Okay. Questions, comments, concerns on this session before we move on to part 3? Let's say there's a lot of opportunity. Okay. A lot of opportunity for people out there, a lot of deal flow. Just got to start marketing. We'll get to that later on. More so than anything else, market for deals, and you can learn as we break down and start getting deals sent to you. All right. Wesley, is it good to understand the terms? And what do you mean by terms? Terms of the note? Terms of vocabulary? Terminology. Yeah, of course you want to learn terminology. Got to learn terminology, but you know what? You learn it more by getting on the phone, talking to people. One of the good things we'll talk about. Yes, terminology is great. And how do you learn terminology? Hey, just keep communicating, keep talking with people. Networking is one of the best things for terminology.